Welcome back to Industry Insights Exclusive Interviews. I'm Julie Miecamp. This is the show where we go beyond the headlines, where we sit down with the people who have actually done the work, built the practices, been in the rooms where the decisions got made, and we ask them to tell us what it was really like. Not the version for the press release, the real one. The CLO market crossed $1 trillion. ETFs that barely existed a few years ago are now showing up in primary deals. The investor base looks completely different than it did even 3 years ago. And somewhere in the middle of all that growth, 2025 happened. And it was, by most honest accounts, a generally hard year for CLO equity. But here is the thing. When Hugh Minch sat down with today's guest, one of the people who runs one of the largest CLO platforms in the world, the explanation for what happened in 2025 was not what most people assume. It was not credit losses, it was not defaults, it was arbitrage compression. Asset repriced faster than liabilities could keep up, and the marks on CLO equity reflected future distributions that were now smaller than anyone had modeled. That distinction is important, and if you do not understand it, you're misreading the story. This conversation also goes deep on the captive equity debate, which has been loud and mostly one-sided. It goes into CLO ETFs and what it actually means for market structure when a retail product becomes a primary buyer. It goes into how the tiering framework for managers is evolving and what the shift towards higher diversity, large cap book is really telling you about where people think the risk sits. And when Hugh asks what data point his guest is watching most closely right now, the answer is not what you would expect, and it is perfect. Before we get into it, please note that the views expressed in this conversation are those of the speakers and do not necessarily represent the view of Octus or its affiliates. This episode is for informational purposes only and should not be treated as investment, legal, tax, or financial advice. Nothing in this discussion should be understood as a recommendation to buy, sell, or hold any security or pursue any particular investment strategy. Listeners should rely on their own judgment and consult their own advisors before making investment or business decisions. Here is Hugh Minch, Managing Editor of Structured Finance Insights at Octus, with Ian Gilbertson.
I'm here with Ian Gilbertson, co-head of US CLOs and portfolio manager at Invesco. Invesco is one of the world's largest CLO platforms, and Ian sits at the intersection of the leveraged loan and CLO tranche investment markets that shape this asset class. Ian, thank you so much for being here.
A pleasure to be here. Thank you.
So let's start with the macro picture. Last year, everyone in the market was talking about tariffs. Then this year, the focus shifted to AI, and then the war in the Middle East, the closure of the Strait of Hormuz, and the second order effects that that's going to have on various industries. So how are you framing the macro environment it's shaping the CLO market today?
Yeah, you're right. And you highlighted a few of the risks that we saw in 2025. And then coming into 2026, I feel like there's a lot of time spent forecasting and you're trying to identify what those risks are. It's always the risk that you can identify that's really going to be the meaningful one, right? So that's at least what's playing out right now. We've seen that play out multiple times where nobody predicted COVID, nobody predicted Ukraine or any of those types of dislocations. And now every single one of my conversations that I have with investors is centered around those two risks that you just mentioned. There's that geopolitical and then the AI and software impact on portfolios. Right now, I think you look at what the market is doing and how it's reacting, and that's a big telling sign of how investors are reacting to those current risks. So you started the year and you had at least the Morningstar leveraged loan index was around 97 was the dollar price. And now we're about 2 points lower. We're about 95 dollar price. But that index average is not even telling the whole story. If you look at the subsegment of software names, it's closer to 90.5 right now as the average price. So that's the market telling you that they're perceiving some risk involved in that industry. I think it's a little early to be able to say with high level of confidence exactly who the winners or losers of that subsegment are going to be. But at least that's the market telling you clearly right now that there's requiring a higher cost of financing for that particular industry. The geopolitical risk is a little bit tougher. You're not necessarily seeing borrowers that have large exposure to Middle East or even oil and gas. It's only about 3% of the index right now. So that's more just making the entire sentiment of the market a little bit more shaky, a little bit more fragile.
Well, I want to talk a little bit more about the geopolitical risk because you mentioned Ukraine just now, and there's definitely some echoes of 2022 with the situation the market finds itself in today. because back then, a lot of energy was removed from the market all at the same time. Then it was Russia, now it's Iran. So last time there was a rate hiking cycle that was great for CLOs. It's a floating rate product. It got a ton of investor interest. But back then we were just post-COVID. There was a lot of stimulus still in the system. So do you think that cushion that there was last time is still there for the consumer and for leveraged loan issuers today?
You hit actually a lot of the major pieces of the question that we're thinking about when how you were phrasing that. So you go back to 2022, 2023, the largest risk to leverage credit was really just how quickly we saw the spike in interest rates. We saw interest rates that really jumped from base rates of 50 basis points upwards to 4.5%. So that 400 basis point increase in base rates was something that if you put that cost on the leveraged capital, the floating rate expense for these borrowers and what they're paying for their debt, that really had a meaningful impact on a 6 to 7 times levered company that maybe had pretty stretched LBO in 2021. So thinking about that business model, that's something that a sponsor probably didn't underwrite to that large of an increase. But you're exactly right. The fastest tightening cycle that we had seen in decades, one of the items that we saw take place there was consumer spending. It stayed relatively strong during that time frame. And it's worth also remembering what you highlight. There was almost $2 trillion of excess pandemic savings that had built up. So then in 2022 and 2023, the dominant macro concern for leverage finance was really just the exposure that a lot of the borrowers had to floating rate debt. If you take your base rate that increases from 50 basis points to 4.5%, that's almost a 400 basis points increase in what that debt was now paying as a floating rate component. So thinking about what that exposure was for a 6 to 7 times levered company that maybe had a more stretched LBO take place in 2021, that's something that a sponsor probably didn't underwrite to. What we saw take place in 2022 and 2023 was really the strength of the consumer that didn't necessarily crack during the increase that we saw in interest rates. Keep in mind, as you mentioned, there was about $2 trillion in consumer savings that were built up during that time period. So that helped to really ease a lot of the transition. One of the key differences that we're seeing from 2022 and 2023 now today is just the shock absorbers are potentially removed from the system. So you don't necessarily have that post-COVID normalization of demand. You don't necessarily have that excess savings. So what that potentially could do is make the consumer a little bit more susceptible to some of these interest rate or inflation type risks that we're talking about.
You must be weighing up the risk of a consumer-led recession in that case. Is that fair to say?
It's something that we've been fearful of, I'd say planning for some time now. It hasn't happened because of the strength in the consumer that we've seen. You haven't necessarily seen negative consumer sentiment that we had seen in 2022 all the way to 2024 really contribute to cracks in consumer spending.
So as we record this, it's only Tuesday, April 21st, and the ceasefire between the US and Iran is expected to expire today, although there's still a lot of uncertainty, I think it's fair to say. But as far as CLOs go, we've seen a normalization, at least in CLO spreads. They appear to be tightening, at least at the top of the debt stack anyway. So what's your outlook for the market in terms of deal formation and also pricing?
Yeah, that's the trouble with doing these podcasts, right? Is we're locking in today. Here's what's happening. We all wake up tomorrow morning. It could be completely different. But as of right now, what's our forecast? I mean, even going back to the beginning of the year, you have to remember coming off of 2025 was such a prolific issuance year, record setting in a lot of ways. Felt like consensus estimates were continuation of that type of pace. And that's really what we saw in the first quarter as well. So expectations for the year were issuance of 180 billion to 200 billion. That's a breakup of maybe 150 billion of broadly syndicated loan issuance and then another 40 billion of issuance in private credit CLOs. And the first quarter was pretty much on pace for that on the new issuance side. If you annualize the first quarter numbers, it's about 140 billion. So even all of the risks that we just talked about, they didn't necessarily slow down a lot of that new issuance. With some of the liability widening that we had seen, maybe now it's starting to tighten back in, but that probably makes it a little bit more difficult for some equity investors to model up a CLO transaction. So do I think that pace slows down into the back half of the year? It's certainly possible, but spreads, they can move very quickly in the secondary market, and then that primary tends to follow.
Right.
The other item on the issuance side is just the refis and resets, which I'd say consensus estimate was for a very active refi and reset environment, anywhere from 250 billion to 350 billion, depending on who you were speaking to. Those numbers have certainly come down in first quarter. The pace of that is probably down 40% year over year. year. And that's primarily from a lot of the liability spread widening that we had seen in second half of February into March. Some of those resets that made a lot of sense are a little bit more difficult with some of the market value movement that we're seeing in loans. When a reset is coming to market, you do have to consider what some of the market value over collateralization tests look like. And so some of those might be switching to refis. And then you have a group of refi transactions that maybe when spreads were at all-time tights, it made sense opportunistically coming to market. Some of those are maybe out of the money now. That deal volume might fall away.
We've certainly got a lot more to ask you about CLO equity, but I want to touch on AI. So when you think about AI and specifically the risk to not just the software sector, but various sectors where companies could be disintermediated, it's not like Iran where there's potentially a deadline and a decision maker. This is something that could bleed through to CLO portfolios of performance for potentially indefinitely, right? So what are you seeing in the loan market specifically, and how are you seeing where stress shows up?
Well, the first part, I think that with any investor or CLO participant is we start by framing what the exposure is and almost defining what software and high tech looks like. And the way that Invesco views it, it's about 15% of the broadly syndicated loan market is tech, AI exposed software names. So it's sizable. That's one of the larger industry concentrations, but not all of those components are necessarily at risk for immediate disintermediation by some of the newest AI modules and tools. So that's something that I think we're trying to keep in mind and trying to evaluate when we re-underwrite credit with this in mind. We've been thinking about AI risks to businesses for well over 2 years now, but I think the risk that it was imposing 2 years ago is much different than it is right now, given some of the new modules and tools that we're seeing and the speed at which they're coming out. So with that in mind, we're trying to view what's the resilience that a business actually has given some of the capabilities that we're seeing. And as I mentioned now, the percentage of the market that's trading about 90 cents on the dollar, the market is perceiving that there's some risk there. The risk being, is there going to be impairment, credit loss, default, or some sort of LME transaction? The biggest concerns that we have is not necessarily who the winners and losers are, because time's going to tell. And I think the financial statements are going to reflect the businesses that ultimately don't have that resilience for some of the new capabilities, but what the rating agencies do and how they react with some of the upcoming maturities within that sector.
So I want to move to a slightly different topic now, which is the market is analyzing different managers. There's this framework that everyone uses. You have tier 1, tier 2, tier 3, and maybe there's some disagreement between who sits where, but that's a framework that most people is generally well understood among CLO investors, right? What is the tiering framework capturing, and do you think that's the right way to think about the CLO market at large?
Yeah, certainly. And you know what's funny is I remember when it was tier 1, tier 2, tier 3, and tier 4. So there was the 4 tiering for the managers, but believe it or not, nobody wants to be called a tier 4 manager. So
what a surprise.
Ultimately, it feels like that has now shifted to there's tier 1, there's tier 1.5, there's tier 2 and tier 3.
But it's the same thing.
Yeah, it made people a little bit more comfortable at least. You know, you're a tier 3, you're not a tier 4. But I think the idea here is that tiering is certainly important. I think it's something that is the right way to look at manager performance and debt execution. And ultimately, it does matter for those reasons. So the tiering that has come up is really just because the growth in the market. You have over 120 US BSL CLO managers. Investors need some way to try and differentiate those managers and those business models. So the tiering, it definitely matters for your debt execution. It matters for your equity returns. And ultimately, I think it matters for the risking of their portfolios and how that collateral manager approaches managing their portfolios. There's also been a big growth in CLO analytics. So a lot of different platforms that can help you analyze the data within CLOs. Going back several years ago, it was a lot more difficult to really analyze how a deal was performing versus the cohort. There are a lot of tools now that make it very easy to see, here's the WARF of a particular deal, here's the quarterly distribution, how does that compare versus a similar cohort? So I think what that's done is for this tiering, it's almost made it where investors are better prepared or better armed to almost now ask better questions of the managers of, well, you said you were going to do this, or this was your style, and you're shifting a little bit.
On that shift, you mentioned previously that there's a lot of managers who would run a so-called higher octane book, which would involve lower diversity, higher conviction, higher weighted average spread. And now you're seeing that shift. Could you talk a bit more about that kind of shift that you're seeing?
Sure. Right now, we're at a place where there's been healthy realized returns on the 2.0 CLO era from an equity perspective. So equity investors now have deals that have redeemed, and they can do post-mortem and look back and say what worked, what didn't through that time frame. And then managers are then able to take that information and then choose what type of style of management that they'd look for going forward. As we've also seen growth in the CLO market, there's also different approaches that you might take for a 1.4 trillion leverage loan asset class that you wouldn't necessarily take in a 400 billion asset class when things were much different in 2015, 2016. We have seen a lot of managers that are moving towards, as you mentioned, higher diversity, sticking towards the large cap portion of the leverage loan market. To me, it feels like that reaction is more getting to a place within the market where now it's sustainable. That type of a business model or management style is sustainable going forward.
So what does that shift tell you about where managers think the risk actually is?
I think the shift is thinking of it from twofold. You're trying to think of performance within a CLO is the debt investors and making sure that debt investors have cushion and there's proper coverage of their debt, as well as the equity, and making sure that those distributions are healthy. The distributions come from the two components of your quarterly distributions, that IO stream, that interest component, as well as that principal return. And I feel like now there's been a lot of discussion on defaults and how those have shifted with the advent of LME transactions. So LME transactions are shifting equity investors to really focus on that component, that principal return. If you're a more conservative, defensive CLO manager, the perception is that you're doing a better job of preserving and protecting that principal.
So since you've been bringing up CLO equity so much, I do want to turn the discussion to that. I think it's generally quite widely understood that 2025 is not an easy year for equity as an asset class. What actually happened last year?
Yeah, 2025 was a difficult year for CLO equity performance. The biggest contributor to that was really just this arbitrage compression that we saw. The equity distributions taking place from a CLO vehicle are going to be based on that spread of your asset, then minus your spread on your liabilities. So spread of assets that we saw from massive repricing activity on the loan side really brought spreads in on the assets much more quickly than we saw on the liability side. When you have a fund that needs to strike price of CLO equity or look at the net asset value of that equity, that net asset value could also be reflecting future distributions. So that price reflecting some of those future distributions that are now shrinking, that had a negative impact on some of the marks for CLO equity. There was also just some loan price volatility that was working its way through some of the equity marks. And then overall in 2025, most CLO managers were burning par in trading activity that they were doing to either reduce risk within their portfolios or sell down triple Cs if they were still within their reinvestment period. So all of that action really just ultimately had pretty negative impact on CLO equity marks for the year. The biggest question that we get posed right now is that an opportunity now? Is that fully baked in and reflected? And our view is yes, that does feel like now spread compression has come to a stop from a lot of the repricing waves that we had seen. Certainly the volatility that we saw in first quarter of 2026 contributed to the pause in repricing wave, but it's also given the opportunity for a lot of structures to roll off of their non-call. And when they're rolling off of their non-call, it's a lot easier to come to market with the refi and reset transactions.
Right. So you're saying it's a story more about the arbitrage compression and less so credit losses.
Yeah, I mean, a lot of times the shift that you'll see in equity NAVs are not necessarily reflective of crystallizing a loss within the position.
So publicly traded equity funds have been telling that story pretty visibly. Obviously, anyone can go and look up those marks. What takeaways do you think investors are getting from that when they do so?
The perception that the market has on how CLO equity fits within an institutional portfolio. And the conversations that I have with potential investors into CLO equity, it's still relatively positive in terms of how can this asset class fit within my broader either alternatives bucket or my privates bucket or my equity alternative special situations bucket. I still have have very good conversations with investors who are looking at their private equity and saying, I'd really love to get some current income from some sort of asset class. And even though CLO equity on the US side was paying 15% annualized returns, now 12% cash on cash returns, it's still really impactful on those portfolios. And that's something that we've had investors really light up when they hear that that's a possible component that they could add to their portfolios.
Right. And I mean, deals continues to get done, right? So there must be someone buying it. You mentioned you're more positive about the CLO equity on a go-forward basis, but what kind of returns are you forecasting for the market at large?
Coming into 2026, there was a lot of bullishness or reinvigorated expectation that we were going to have new loan issuance. I think that's what the marketplace is really yearning for and waiting for, to be able to continue the demand that we're having for on the liability side, both debt and equity. So if we do have a situation where debt liabilities and the almost insatiable demand that we have for that highly rated AAA CLO paper can be met with that new loan issuance, that's going to be very accretive or impactful to equity returns in the future years.
Related to this, there's one topic where every investor seems to have an opinion, that's captive equity funds. They've raised a lot of capital. Yourselves at Invesco obviously have raised captive equity, and they're driving a larger share of overall issuance. So some people, if I talk to a third-party investor, they'll say that one of the reasons that modeled equity returns have come down is because of the captive equity fundraising has contributed to managers being able to print deals at uneconomic levels. So what's your read on that debate?
I'm glad that you point out the disclosure, because Invesco does finance its CLO issuance from a captive equity strategy. And that's something that we find tremendous value in. But stepping back as just a participant within the CLO equity ecosystem, I've heard the debate taking place, and I do understand third party and captive equity and the arguments for and against. Realistically, I think there's a place for both strategies within the industry. Thinking about the potential conflict of interest for a captive equity strategy that is looking to just try and grow AUM by issuing CLOs, that is a fear, and I think that's rightly pointed out by the market. There are ways to protect against that with some of either the fee structures within the captive fund, or just from establishing a relationship with a platform that doesn't necessarily print to just raise AUM. That's one thing. But then there's also just the idea that captive funds have been really successful in issuing in periods of dislocation. You go back to 2022 and 2023, like we were talking about, there was third-party equity on the sidelines because modeling it out didn't necessarily make a lot of sense. Captive equity was one of the only participants in that market environment. And some of those vintages could potentially pan out to be some of the higher returning vintages of the 2.0 era. So having that ability to act quickly in a captive fund strategy does offer some good benefits to the investors who buy into the strategy.
Right. So more correlation than causation. That fundraising activity in captive equity funds, is that something you expect to continue at scale?
I think so. I mean, there are certainly a lot of managers out there. Every single CLO manager should look at the ability or the possibility for them to finance their CLO issuance using a captive fund structure. And the captive fund structure could potentially also pair well with certain LPs and limited partners that are looking to get exposure to CLO equity. Think of yourself as an LP who's looking to potentially underwrite this asset class. If you're looking to partner with a platform that you are working with on the direct lending side, on the real estate side, and now you're looking to get CLO equity exposure, that's something that could be very easy for you to get comfortable with investing in that platform, rather than looking for some sort of portfolio manager that could carry some key man risk if it's just a fund strategy of third-party management.
Yeah, we're still seeing a lot of new managers coming to the market all the time, and a lot of them are coming with captive equity capital. What does that tell you about, is the asset class actually stretched as thin as some people are suggesting?
The idea that there are a lot of new managers that are launching is just reiterating how successful the asset class has been. You think about the default rates historically that have taken place in CLO debt tranches, you compare them to corporates on a like-for-like rating, they're materially lower. And that's been proven through GFC, that's been proven through oil and gas issues, COVID. So the CLO structure itself has been very well tested. And I think that's also driving a lot of the new manager growth and demand, is the success of the CLO structure within the corporate loan format.
I'm going to pivot a little bit, because we've been talking about captive equity, and you obviously have a captive equity fund, but you also have a CLO ETF. And that's, I think, important because of CLO ETFs, the buyer base for the CLO market looks very different than it did, even just like 2-3 years ago when these funds were in their infancy. What's interesting is that you can track CLO ETF flows. It gives you a real-time indicator of demand. My question for you is, how has that visibility changed how the CLO market functions, especially some of these funds are big enough to participate in the primary market as well as buying bonds in the secondary?
Yeah, the growth has surprised everyone who's participating in the space. Now, we're about 45 billion in AUM in CLO ETFs. And just to think about as a percentage of the overall market, an easy calculation to do is just the CLO market on the US side is 1.15 trillion. So that's about 4% of the market. But I think even that is probably missing out on how impactful the CLO ETFs are as a participant within the market, because most of those CLO ETFs do have a focus on the top of the capital stack, AAAs and AAs primarily. So if you think of that exposure within CLOs, there's probably 600, 700 billion of AUM outstanding. So ETFs at 45 billion, it's probably closer to 7% of the overall market. So it's meaningful. It's an active participant in the space. But I think to your question on how it's impacting those spreads or really affecting some of the marketplace, we've seen it because it's very topical and it's very transparent. So you can really see those flows per fund on a daily basis. However, I think going to market and bringing a transaction, it's not necessarily an ETF buyer going to dictate if a CLO equity participant wants to go or no go on a new deal transaction. It's really still almost a marginal buyer. If you think of it as there's another 93% of AAA buyers that are always active in the market in some way, shape, or form. So you can really see the flows that are taking place on the ETF side, but you have to remember it's a lot of times the US banks, asset managers, insurers who are also there participating in a large way.
Yeah, so the marginal buyer, but also arguably the marginal seller as well, right? What does this mean for overall liquidity in the CLO market?
2026 is a great example, right? Because we did have a lot of volatility, and AAAs in particular, when you think of that part, because 90% of the CLO ETFs are AAA focused, they're going to have this dynamic where the liquidity increases even when there's the added volatility. So you look at March, for example, investment grade trace volumes, they were about 40 billion in the month. That's almost twice what they are typically. And even just looking at AAA BWIC volume, it was about 4.5 billion in just March alone. So that increase that we saw in liquidity aids the ability for participants to get comfort in CLOs within these structures. But then if you think about how it impacted spreads, we didn't necessarily see outflows from a lot of the top of the capital stack ETFs. So there was continued inflows in March, but we still saw spread widening. So it wasn't necessarily this fear that we've always had of volatility is going to increase. You're going to have CLOs that are forced sellers, and then that's going to widen spreads. Well, spreads still manage to move around because of the other 93% of buyers within the AAA asset class.
So meaningfully impactful, but from your seat also as a CLO issuer, you're not going to be looking at ETF flows and deciding now's the time to go and price the transaction.
Yeah, unfortunately, we can't be those day traders like, okay, today the inflows are this, let's launch the transaction now. That would be nice. On the marginal side, you probably do see ETF flows are really, really strong. Maybe that opportunistic refi that you were looking at or that was in your pipeline gets moved up a little bit, but it's not necessarily going to be sculpting the new issuance pipelines for a lot of the managers.
Yeah, so I guess every CLO is bespoke. The docs are heavily negotiated, and AAA investors have their asks, and mezz investors have their ask, and overseas have unique calling cards they could lean on. Is an ETF a different kind of CLO buyer from a structural perspective, or is it just another AAA bid?
You're right that it's interesting when you look at the docs and even at Invesco, look at our docs that have taken place from 2016 all the way to 2026 over that decade and how much they shifted even at the same collateral manager. It really does play into just the phase in terms of how CLO docs naturally do change over vintage life cycles, as well as the investors that are participating, not even just at the top of the capital stack, but who's the equity investor and then who is the mezz investors within a transaction. So all of that all comes together to kind of give CLO doc its fingerprints, the feel of that document will look like. So it's really difficult to point and say ETFs have had an impact one way or the other. It could just be the natural life cycle of 2026 vintage docs are moving in this direction, or that mezz investors had certain steps for a certain doc that we had in our last deal.
Okay, so I want to tie that back to what we were talking about a little bit earlier. If we in a higher rate environment or a higher for longer rate environment again, and we have another 2024 in terms of AAA CLO ETF demand, demand. Do you think that if they grew again in a similar manner, do you think they could start being more influential in terms of shaping the structure of CLOs in the market, or is that still a long way off?
It's a long way off. I think we'll have to wait and see. I'd love if we do have another 2024 in CLO ETF flows. Selfishly for the Invesco ETFs, I'd love to see some of those inflows come in. You do need ETFs to be a certain size to be really meaningful in participating in primary transactions. And so I think we need a little bit more time for ETF growth to take place before there's going to be the footprint or the fingerprints of the ETFs really changing the landscape of those stocks.
So one thing you often hear from market participants is that fundraising still requires a large amount of conversations with institutional LPs, with family offices, etc. What are some of the misconceptions about CLOs that you still come up the most?
Misconceptions don't necessarily have to be negative. A lot of times, misconceptions sometimes can just be the education process that takes place with investors. CLO equity is still an asset class that sometimes there's a participant that knows Invesco really well, knows CLOs, but the equity portion is a little unique. And I think just talking about some of those cash on cash or current income and the benefit that brings, that's still a misconception to a lot of investors right now. So having those conversations is a net positive when we can educate investors on that and really show them some of the benefits of the asset class. Other misconceptions are just making sure that individuals, even on the institutional side, are aware for broadly syndicated CLOs, it's not necessarily directly tied to some of the direct lending or private credit news headlines that are taking place in the market. Every institutional investor is unique from the perspective that they're coming at and how they could be positioning CLO equity within their portfolios.
Yeah. So to kind of pull this all together, as you're looking for the 3 quarters of the year, are we turning a corner on the volatility that we saw in Q1, or do you think some of those trends are likely to carry? What's your base case for projections for the rest of the year?
Yeah, that's the crystal ball questions, right?
Indeed.
It's difficult. As of right now, it seems like we have started to see liabilities start to tighten back in now into the past couple weeks. That's giving us positive that the market really wants some of these geopolitical risks to get alleviated so that we can move on to some of the other concerns that are starting to show up within portfolios. I think the market is hoping for, and then now we're just cautious of if that doesn't play out, if there is another surprise or another headline that we're not currently prepared for, what that potential impact could be.
Sure. If someone watching this is an institutional investor and they're looking to build a durable position in the CLO market today, what are 1 or 2 things that they should be asking CLO managers?
Sure. So the first, I think, would be identifying what's their risk reward tolerance and where they would look to participate within the capital stack. A AAA investor conversation that I have is much different from a CLO equity investor conversation that I have. But once that's identified and ironed out, really just the partnership that you would look to potentially build with a collateral manager. Are you looking to potentially partner with somebody who is part of a large asset manager with multiple capabilities? Are you looking for a partnership with a CLO manager that's maybe a smaller boutique, part of a long-short hedge fund, part of a private equity entity, maybe part of an insurance company? All of those give different DNA to the actual CLO manager and how they operate within the part of the CLO marketplace.
So the last thing I want to do before we wrap up is just do a few quick ones. So short answers, just the first thing that comes into your mind. How's that sound?
Sure, let's give it a shot.
All right, okay.
Lightning round.
What's one thing you've changed your mind about in the last 10 years of running CLOs?
In the last 10 years, so this is a long time, I would say trying to look at it over the long run, because making the quick decisions, you don't want to be short-sighted when you're trying to keep discipline in credit.
What's the one data point you're watching closest right now?
Tweets and what comes across. Unfortunately, social media platforms. And
fantastic answer. Okay, what's the one CLO market misconception that you wish would disappear?
Rating agencies tied to perceived risk.
Okay. What's one piece of advice you wish you received early in your career?
Probably the piece of advice that I give now is just be nice to people. You know, the CLO market, even though it's grown so much, is still very close-knit. I feel like I was a credit analyst for a while. I was a CLO debt tranche trader, CLO structurer. It can be really easy to want to try and grab the last basis point or the last dollar in a trade or a transaction. But you're going to see all of these industry participants. So just being kind to people.
Yeah. So this one is slightly similar, but just giving your answer to that one. But what's one thing that young professionals in credit consistently underestimate?
One thing that we see is just being able to make decisions with imperfect information. And that's a skill that I think credit analysts can always aspire to and to work on and to be better at, because because you're never going to have 100% certainty on any of the trades or transactions that you're doing, but having enough confidence that you've covered some of the downside scenarios, that's good enough in a lot of cases.
Ian, I really appreciate you coming on. I think a lot of this stuff is top of mind for a lot of people in the market right now. So very fascinating to hear your thoughts on this subject. Thank you.
Of course. Thanks, Hugh.
That was Ian Gilbertson in conversation with Hugh Minch. CLO equity had a hard year. The reasons are specific, they are knowable, and they matter enormously for how you think about what comes next. Ian laid them out clearly and without spin, which frankly is rarer than it should be in this market. The Octus team tracks structured finance and leveraged credit every single day with the depth that makes conversation like this one possible. If you want to go further, check the show notes. A huge thank you to our producer Tanya Hubbard, who makes this show possible. I'm Julie Miecamp. Thank you for listening, and we'll see you next time.